Most people think multifamily investing is only for developers and full-time real estate professionals. The truth is, multifamily is one of the most common ways passive investors build long-term wealth without even owning the property themselves. Today, I'm going to break down how multifamily investing works for passive investors and why so many people start here. My name is Roberto Carabetta. I'm a senior living and multifamily owner and operator, and I help investors earn passive income through commercial real estate. This channel is focused on educating investors who want cash flow, equity growth, and the simplicity without being landlords. Let's break down multifamily investing from a passive investor's perspective. What multifamily really is. Multifamily simply means residential properties with multiple units under one roof. This could be anything from a small apartment building, say 20 units, 15 units, 20 units, to large communities with hundreds of units, 200, 300, 400, 500 units under a roof or on a plot of land with multiple smaller buildings. For passive investors, multifamily means owning a piece of a large asset that's professionally managed. Why multifamily attracts passive investors? Hey, multifamily housing is always in demand. People need a place to live, regardless of the economy. That creates consistent occupancy and predictable income. Investors like multifamily because it produces steady cash flow, long-term appreciation, and tax advantages. You can sleep at night as an investor and not worry about, is the company doing good? Is the company not doing good? Is there a news release? It's not like a stock market that is volatile and goes up and down. Multifamily investing is very, very simple, especially for a passive investor. Less worries, less stress, and less volatility. How passive investors participate in these deals. As a passive investor, you invest your capital into a syndication or a partnership. The operator, like myself, the general partner, handles acquisition, renovation, the management, the financing, and the execution of the business plan. You receive distributions on a quarterly or annual basis, and your equity grows without being involved in the daily operations. You can still concentrate on your W-2, on your entrepreneur journey, on your job. You concentrate on what you love to do and what you're good at. And us GPs, a good operator like myself, handles all the rest. So now you're thinking, all right, I like the investment. I want to invest. But where's the cash flow coming from? With every investment, before you invest any money, you have to understand how you're getting paid. What is generating the cash to pay me, the passive investor? Well, it can come from a couple of different angles. But multifamily cash flow comes from rent collected across many units because income is spread over dozens and hundreds of tenants, not just a single family tenant that you relied on one paycheck a month. The risk is diversified. Even if one unit is vacant, the property can still produce income. If you have 100 units and 2 people move out, that doesn't hit your bottom line as much as having 4 units and 2 people moving out. That's 50% reduction in occupancy. That's a huge hit. But on a larger scale, 1 or 2 tenants moving out, it doesn't really affect the cash flow. How do we create value in multifamily properties? So value is created by increasing income, controlling expenses. The income can be increased by renovating units. So if we renovate a unit to keep up with our competition in our market, we could potentially get $25, $50, $100 more rent per month from that single tenant. Combine that over 100 units, that's a lot of monthly income just by renovating the unit. Improving management is another way that we create income. Improving management can be decreasing expenses, or some line items we increase expenses. For example, marketing budget. When we analyze a potential deal, we look at marketing budgets. So if we can potentially increase marketing budget, that can attract the right tenant, our right avatar, and our right tenant base just by increasing that line item. So it's not always about decreasing expenses. It's about improving management and controlling expenses. Most expenses have to decrease, but marketing, for example, has the potential, not always, to increase. Increasing rents to market levels is just an easy, simple strategy without even potentially renovating the units. Some assets we find are just below market rents simply because it's a tired owner, a mom and pop shop, a mismanaged operations. They haven't increased rents in 3 years, 4 years, 5 years. They're always below market levels. So we come in there and we can just jump rents by $25, $50 without even doing the renovation sometimes. We reduce inefficiencies and improve tenant retention. We're signing 1-year leases, but we don't want our tenant to leave after 1 year. The longer a tenant stays on our property, the more beneficial it is to us because that unit is always being occupied. And on an annual basis, we can increase their rent as market conditions improve. Imagine the tenants move out every single year. Now you're stuck with an empty unit. It might be 1 month, it might be 3 months, it might be 5 months. Who knows what time you're going to get that additional tenant in there to replace the one that moved out. So tenant retention is huge. As income increases, the value of the property increases. So you have income minus expenses equals your NOI, net operating income. Your NOI is measured against a cap rate. I'll talk about that later on in a different segment. Your NOI is measured against a cap rate, and that determines the valuation of your property. So the higher NOI means potentially the higher property value. A simple multifamily example. Let's say an investor places $100,000 into a multifamily deal. That investment may generate quarterly cash flow while the property is getting improved. Over time, income is increasing. The operator is doing well. The expenses are controlled. They're in line. Rents are escalating. This investor benefits from two sides, cash flow and equity growth, at refinance or at a sale event. The real estate is appreciating year over year. Then the operational benefits that we're implementing our strategies on is increasing at a faster rate. You combine those two, then the limited partners join in those returns. So every investment comes with risks. So you have to understand your risks. Stocks have risks. Commercial real estate have risks. Hard money lending has risks. Every investment you make has a risk to it. In multifamily, the risks include rising interest rates, poorly managed properties, and unexpected repairs or economic shifts. We can't really predict the future. We're looking at a 5-year hold period. We don't know what's going to happen in year 4, year 5, or longer. We can assume based on our data and our experience, but we don't know what's going to happen in the economy. So that's one risk that we heavily favor to try to minimize in our underwriting and business plan. This is why operator experience, conservative underwriting, and a strong market matter. So if you have an experienced operator who's done this before, who's been in the game for a long time, and an underwriter that knows how to underwrite conservatively and not to push the needle too far. If you have an underwriter that's too aggressive, that wants to just force those metric returns so the LP sees a shiny return, a shiny object, that can be a recipe for disaster. As a limited partner, you have to understand the underwriting. Know that there's a little buffer, a little room to play if one part of the business plan doesn't go according to plan. Being in a strong market matters. You can't be in the middle of nowhere and hoping that I got a good deal on a purchase price, a good purchase point, but you're in the middle of nowhere. So what's your exit strategy? A, who's going to buy it? B, where are you going to find the tenants? If you don't have the population, if you don't have the economic growth, if jobs are not coming into that market, and if that city or that market is not expanding, then who's going to move into your multifamily property? You need the population and economic growth. So being in a strong market matters. So you have operational experience matters, conservative underwriting matters, and a strong market all matter. Why multifamily is often a starting point for investors? Many passive investors begin with multifamily because it's easier to understand. It's real estate without heavy operational complexity. It offers stable returns and helps investors get comfortable before moving into more operational heavy asset classes like senior living, my favorite. So you have a whole different type of asset classes underneath this commercial real estate umbrella. You have multifamily, hotels, RV parks, and my specialty, senior living. So multifamily compared to single family rentals, multifamily is more scalable and effective. Compare that to senior living, multifamily is less operational, but typically produces lower cash flow. Each asset class serves a different investor profile. Maybe an investor like yourself likes more risk and willing to take that chance on a senior living opportunity, knowing that there's a higher return. Or you're okay, you have a diversified investment portfolio, you're just looking for more stabilized, sleep at night type of investment, and you might look into multifamily. It might produce less returns, maybe double your money in a 5-year hold period, as opposed to senior living where you can triple your money in a 5-year hold period. But those lower returns mean lower risks, mean more stability, less volatility for the investor. What passive investors should be looking out for? There's a lot of operators out there that I can personally say don't know what they're doing. On the flip side, there's also a lot of great operators out there that are doing a great job. So strong operators track record, a clear value add strategy, conservative rent growth assumptions, reasonable debt terms, transparent reporting. The quality of the operator is the most important than the property itself. So conservative rent growth, we talked about the underwriting part of being conservative underwriting, but rent growth assumptions. So year over year projections, we input a percentage of rent growth. What is rent growth on year one going to look like in year two? It can't be a 10% increase. That's almost impossible. I personally like to increase multifamily rents on a 3% year over year rent growth. My expense rent growth is also at 3% year over year. That essentially cancels each other out, meaning that's a conservative underwriting for the limited partners and for myself. If the business plan works out on a 3% rent growth and a 3% expense growth, then that to me is one step closer to success. Reasonable debt terms. This is where a lot of operators get it wrong. And LPs, you limited partners, don't think that every debt is good for that property or for that asset. The saying goes is, it's what you buy the property at and how you structure the deal that wins the deal. It's not all the in between year one, year two, year three. It's how you structure the deal, structure the capital, structure your debt accordingly. You don't want to get good debt terms at year one, but you misread the debt terms and now you're stuck in year 4 or 5 and you can't refinance, you can't sell, or if you do, it's a high fee you got to pay. That high fee eats into the limited partners' returns. Transparent reporting. You have access to every financial aspect of the property. You're an owner yourself. You have an equity position. So transparent reporting. If the operator's hiding something from you when you're asking for financials or any other information, that should be a warning sign. General partners are able to give financial data to any limited partner that's requesting it on a monthly basis, on a quarterly basis, on a semi-annual basis. Us general partners have a monthly reconciliation and a monthly reporting every single month throughout the whole hold period. Like I said, the quality of the operator is the most important piece of the puzzle. Team up with a professional, experienced operator, and your chances are you're going to have a successful investment. Why multifamily fits this long-term wealth generation investment? Multifamily allows investors to compound wealth over time through consistent cash flow, appreciation, and tax benefits. It's not about the quick wins. It's about the steady and durability of the investment. Imagine you're buying a stock, Apple, Nvidia, Tesla. Yeah, they're good stocks, well-run companies, but they could be volatile. One news event could shake the market. It can go up, it can go down. You don't know. But you compound a steady, trusted investment like multifamily or commercial real estate, compound that over time, that $100,000 investment can multiply into millions of dollars in under 20 years, under 15 years. It's a long-term play. This is not a get-rich-quick scheme. You have huge tax advantages. You have huge compounding interest, compounding wealth effect. This is a generational wealth builder. If this video helped you understand how multifamily investing works for the passive investors, like the video, subscribe to the channel, comment below if you want me to compare multifamily and senior living side by side. I'll break down what a real deal looks like. So comment, like the channel, subscribe. Thank you for showing up. Thank you for believing in me. If you want to be an LP investor, talk to me, reach out, let's connect.